Welcome to the Note Investor Podcast. We'll guide you through the ups and downs of note investing and teach you all about the nitty-gritty details of the business that other people won't talk about. Your host, Dan Deppen, is a former aerospace engineer and product manager who transitioned away from cubicle life to full-time note investing in 2018. Our website is www.fusionnotes.com, where you can subscribe to this podcast, comment, and find links to other information on note investing.
Hey everyone, welcome to the Note Investor Podcast. I'm your host, Dan Deppen, and today I'm going to be talking about some predictions for the housing market in this coming year in 2022. And I'll start off up front by kind of apologizing if my voice sounds off. I've been fighting what I hope is a cold for about the last week or so. I've had a couple negative COVID tests, but this stuff has really lingered and is a giant pain, but I finally wanted to get this one out. So Happy New Year to everybody. I hope you're off to a good start in 2022. I know my holiday season was good. I spent a lot of time with family, had a bunch of people come to visit, and everything worked out well. It was really nice. However, I've since then gotten sick. Actually, one of my daughters just found out today has COVID. So that's been kind of a giant pain in the butt. Also, as you may be aware, at the very end of the year, had a bunch of fires in Colorado. So a lot of people have reached out, to see if I was okay, which I greatly appreciate because I live kind of in that vicinity. But, fortunately, my house is about 7.5 miles from where the fires were. So I was okay, which I'm very thankful for. But I do have at least a couple friends who lost homes in that. So it's definitely been a very strange couple of weeks since Christmas. Note business, has been good so far. Kind of my focus here in January is to work on finding some new notes to buy. I really want to expand my portfolio as we get into this year, but between being knocked out, being sick, and a few other things that have come up, I'm a little slow on the uptake to get that. I did have one note deal that closed out. I might do a case study on this at some point in the future. It was interesting. It was a note in Cincinnati that had performed for a pretty long time, and then it stopped. Borrower was uncooperative, started the foreclosure process, and the borrower got an attorney and really fought me on it, which is really the first borrower I've had really put up like a legit fight over one. And we ended up reaching an agreement where he would do a short payoff, which I wasn't happy about it because I ended up taking about a $7,000 loss on the deal when it was done. And I think if I had stayed the course in the legal process, I most likely would have been made whole. But I ended up taking the deal and just getting out of that one because when you get into kind of a non-standard legal process, the legal bills and the timeline are very, very open-ended and they can rack up quickly. And I was concerned that this guy was such a lunatic that if I ran this to ground finally and got the property back, God only knows what kind of condition it could be in, and I might drag it out and take a bigger loss. So I decided to cut my losses there and move on. That was actually a deal that happened last year, but it got finalized in January. And then I've had two other borrowers so far in January ask for payoff amounts. And so they want to pay off the loan, which that would be awesome. We'll see whether or not those two follow through. If they do follow through, they would be about roughly $13,000 and $14,000 wins, respectively. So that would be like an awesome start for the year. So far, some interesting stuff. But I just wanted to give you an update. But the main thing I want to talk about today was the housing market in 2022. So there's a website called financialsamurai.com that's a general like personal finance, has all kinds of economic and financial information. I really recommend Financial Samurai. I think it's a great site. The guy who owns that was a former like investment banker, did some other stuff, and what I like about his articles is they're pretty long and he really goes into depth on why he believes what he believes. And he had an article titled 2022 Housing Market Forecast, Another Boom Year. So if you go to Financial Samurai, you can find this article on there. And so what I'm going to do today is go through some of Financial Samurai's takeaways and talk about what that might mean for the housing market in this coming year. And then I'll kind of wrap up with how that might impact you as a note investor. So getting into the housing market, and if you're watching this on video, I'll show some charts. If you're just listening to audio, that's fine. I'll describe it all. But if we look at housing prices since really the financial crisis, the median sales price of homes sold in the U.S. back in 2011, 2012, it was around 220,000. That climbed to about 320,000 prior to COVID. And since COVID hit in 2020, it's gone from about 320,000 to a little over 400,000. So part of me looks at this and goes, man, this is like almost a doubling in the median sales price of homes in about 10 years, which seems pretty nuts and unprecedented. So that would, kind of lead me to believe that we got to be finding a top somewhere, right? Like I wouldn't look at that and think there's a lot of room to roam upwards after that. But for a variety of reasons, I think there actually is room to go quite a bit higher. So reason number one is low and negative real mortgage rates. So one of the things Financial Samurai talks about is how mortgage rates are really tied to the 10-year bond yields, not so much the Fed discount rates. And so if you look at, some of the predictions or things that are happening in the bond markets, those long-term 10-year bond rates are staying kind of low, which implies that, we might see a little bit of an increase in mortgage rates, but I expect those to stay at, near these historical lows that we've been enjoying for many years now. And then I also mentioned that, mortgage rates are not just low, but the real mortgage rates could be even negative based on inflation. So we've had a lot of inflation definitely over the past year. If that continues, that makes it more desirable to borrow money, right? Because if you're in a high inflation environment, you borrow money and then there's inflation, you essentially have to pay less back. Your debt's getting inflated away, right? Like much like a government might rack up debts and then print money to, kind of subvert the debt. You can do sort of a similar thing with mortgages if inflation stays high. However, the interesting thing is Financial Samurai expects that inflation rate is actually probably going to settle down. So I did some digging on my own too, and it's really interesting. So if you go to the St. Louis Fed website, they have a graph of a 10-year break-even inflation rate. So they have 10-year treasuries that they sell, but there are also 10-year inflation-adjusted treasuries. So if you look at what they do is they do a comparison between just the straight 10-year treasuries and the inflation-adjusted ones to see where they're trading at. And so what you can interpret from that is the market's belief in what inflation rates are going to do in the future. Now, the market could be wrong, but this is like the whole market, right? Like trillions of these bonds are being traded, so their predictions are going to be pretty good for the most part. But if we look at their historical trends, we've had this inflation rate around 2%, and it's gone up now, but they have it, projecting out at about a 2.5% increase. So probably an increase in inflation overall, but I don't know that we're going to get into these really high rates of inflation, or like rates of inflation of like 6+% like we've had in the last year. I think that really probably has been somewhat of an anomaly. All right, so the second reason for a housing market is a permanently higher demand curve. And so what this means is we have a lot of millennials who are now hitting the point of life where they're buying houses. In fact, millennials make up the largest percentage of home buyers by generation, and that's going to continue. So, this increased demand for homes from these younger generations is going to basically shift the demand curve up. When the demand curve shifts up, typically that will bring pricing up with it as well. The third reason is an increased demand from institutional investors. So there have been a lot of stories in the news about various private equity firms and other large institutions buying up real estate, buying up rental properties in a search for yield. Right now, the bond markets aren't providing these folks a lot of yield. The stock market, is very swingy. So a lot of people are looking to real estate as a way to get higher yields with less volatility. And even though some big institutions like Zillow have screwed things up with their iBuying, I think there are a lot of big institutions out there buying up homes, increasing the demand, and that should continue. The fourth reason they gave, which is one that I haven't really thought about too much, was increased demand from foreign investors. So you see this more like just in specific markets, often on the coast. And since COVID's hit, foreign investment in U.S. real estate has decreased quite a bit. But at some point when we finally get on the backside of this pandemic and travel restrictions loosen, you'd expect more foreign investment to flow back into the United States. And, why would they do that? That leads us to reason number 5, which is the values of property in the U.S. compared to the rest of the world. Even though we've had this big run up, and almost a doubling of real estate prices in the last 10 years, comparatively speaking, property of real estate in the U.S. is lower, a lot lower than a lot of other places in the world. So if we compare, the United States to Canada, and if you're watching on video, I've got a chart here that shows trends of disposable income relative to home prices in the U.S. And when you look at Canada, there's a massive difference. Like the home prices are about, 75% higher than in the U.S. relative to disposable income. So that's signaling to me that there's still room to grow in values. I mean, one of the things that I thought about as this boom has gone on is, well, at some point, you're going to hit a natural limit to what people can afford to pay per month for housing. And we got to find that somewhere, and maybe that's going to define the top of the market. What this is telling me is that we may be nowhere near that threshold, and there could be a lot more room to run. Number 6 is strong wage and job growth. So right now we've essentially got full employment. I was reading something in the Wall Street Journal the other day. The unemployment rate's been lower than it's been at any time, like all the way back through the 90s. Like even in that smoking hot economy in the 90s, we've never quite seen unemployment this low. A lot of that is because of, people who decided to quit jobs since COVID, which honestly, I'm still trying to figure that one out. I'm still a little puzzled how it seems like several million people can suddenly afford not to work, and that's okay. It makes me think maybe I'm doing something wrong. I haven't quite cracked the code on that one yet, but the fact remains across the board, whether it's just like retail type jobs, they're having a struggle hiring. In my day job as a product manager, we need to hire engineers That's a big problem. I'm getting pings from people all the time with job offers. It's just a really crazy, nutty market. And we're seeing wages increase as a result. There were a lot of articles around Christmas time in the Wall Street Journal talking about how the average raises this year are much higher than they've been in a long, long time. And that wage growth in the U.S. is actually higher than it is in other parts of the world, like the Euro area or Australia. And so that just provides more of that disposable income for people to spend on housing. Reason number 7 is rising building costs. So with that, inflation, kind of everything it seems like has gone up in price in the last year. Building materials in particular, lumber prices are through the roof, and even copper prices are way up. So last year I had a property get stripped of copper and wire. Apparently that's becoming a thing again. I thought we were kind of done with that since the financial crisis. But what these rising building costs mean is that the replacement cost of housing is much higher. So there is a limit. There's an undersupply of homes available, and these high building costs mean that it's not that easy just to go out and build a lot more housing, even though they are building, at a higher rate than they have, I think, since the 70s probably. But that, definitely keeps a floor under housing prices. I was also reading an article today, so I mentioned the fires we had in Colorado where about 1,000 homes got destroyed. And they're saying how a lot of people had, insurance policies set to the market value of the property, but now that these building costs have gone up so much, a lot of people, their insurance policies aren't necessarily going to cover all the costs needed to rebuild. So this is a big, big problem, but it puts more upward pressure on housing prices. Number 8 is the declining supply and inventory. So there's just not a lot of inventory on the market. I've got a friend here in the Denver area who's a Keller Williams realtor, and he was telling me a while back that in the Denver metro area, they need about, for the whole metro area, about 35,000 properties on the market to have what they consider a balanced market. And at the time, there were only 3,500. So, in the Denver metro area, we're looking at about 10% of the inventory needed for a stable market. And I think it's gotten even tighter since then. Then you have the fires that take 1,000 properties away, and it gets even worse. So the supply and demand equation is way, way, way out of whack. And I've got a chart here showing the housing supply. So back like in the early 2000s, there were about 4 or 5 months of supply that spiked during the housing crisis when there was a flood of houses on the market and went up to around 10 months of supply. And really since about 2013, when it got back down to about 5 months, it's just slowly trickled down. And right now we're only at about 2-3 months of supply, which is like practically nothing. So how supply and demand works. I mean, if you want prices to go down, you're going to need more supply at some point. All right, so that's a whole bunch of reasons why I think housing prices are going to continue to increase. So, the big question, since this is the Note Investor podcast, is what does this mean for note investors? Well, I mean, number one, it means that if housing prices are going up, the value of the collateral on your notes is going to continue to increase. For an existing portfolio, this is great because it means those borrowers are going to probably gain even more equity. Like I know almost all the loans I have now, borrowers have a lot of equity. So that's just all the more incentive for them to perform. Or, in the situation where someone, borrowers aren't always rational. In the case where someone doesn't perform and they're not willing to work something out and you have to go through foreclosure, it de-risks taking on those REOs, right? Because as I've talked about many times, you do foreclosures, it's a giant crapshoot when you get the property back. Some of them are absolute home runs. Some of them are like, oh my goodness, what's going on here? But when you have overall higher housing values, it really makes that a lot risky. Now, if you remember from the conversation with Franco Barilli towards the end of the year, we still have this wave of foreclosures coming. That isn't going to change. So that should increase the supply of notes. So we should have more of it. I still believe there are going to be more notes coming available here at some point in 2022. Now, the big question for me is, okay, if the value of collateral is going up, that tends to push prices up. If we have a foreclosure wave that increases supply, that tends to push pricing down. So where is pricing on notes going to end up? And that's a big question mark. For me, I think performing notes are probably going to sell at more of a premium. But we'll have to wait and see. And when these non-performing notes hit the market, they're going to be foreclosures. Yeah, I mean, the pricing is going to be higher than it was, say, 5 years ago, because the value of the properties are higher. You might see more foreclosures where there's actually equity, which, gets a little weird on pricing. So there may be more emphasis on figuring out what the value of the property is, which can be difficult when you can't see inside the property. But I would, caution people not to get anchored on pricing of the past when it comes to these things. I think that's caused a number of note investors problems where they participated in the market at a point in time where things were just priced absurdly low, and they anchor on that as the pricing they have to pay, and that's caused them to pass up some good deals over the last few years. So you still need to do your due diligence, understand your pricing model, but understand that the total, percentage of BPO or percentage of UPB that you're paying might be quite a bit higher than years past, and that could still be a very good deal. All right, so, that is going to wrap up where I think the housing market is going in 2022. I'm curious to know your thoughts. Just drop me an email, dan@fusionnotes.com, or leave a comment on the YouTube channel. I always appreciate that. There are a lot of really sharp people who listen to this that have a lot of really in-depth knowledge. So I'm interested in what points you might have or other considerations that I didn't bring up here. And if you want to learn more about investing in notes, and if you want to get in the game and go from just learning about notes to becoming an active note investor in 30 days, you can check out my online training course, Note Launchpad, at notelaunchpad.com. So it's a completely online course, a ton of videos, downloads, calculators, templates, checklists, the whole 9 yards, and then my Note Ninjas private Facebook group to help you so I can answer questions. So anyway, until next time, I hope your new year is off to a great start. Let me know how I can help you in your journey as a note investor, and I'll see you next time. Thanks.